Good afternoon, financial professionals. Abby Fletcher here of E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thanks for tuning in today. For those of you joining The Brew for the first time, we like to start the Brewcast by celebrating today's National Day for October 21st. First up, today is National Pumpkin Cheesecake Day, one of America's favorite desserts, and by adding pumpkin, we celebrate the essential flavoring of the season. The internet tells me that cheesecake dates back to ancient Greece. It's been said that Greek brides would make cheesecake for their wedding day, and this led to wedding cakes being the norm. Also, today is Support Your Local Chamber of Commerce Day. This organization has been in existence since 1912. Special thanks to President Taft, who brought this concept for an organization that would represent concerns of U.S. businesses before Congress. Many of you are part of the Chamber of Commerce, and the best way to honor the Chamber today on their special day is to use the services of your local Chamber businesses. Treat yourself to something local today, perhaps some cheesecake. Today on The Brew, we have our partner, Craig Geiger, who serves as Regional Sales Director of Annuity Solutions at Lincoln Financial. He'll be sharing insights on using a FIA as a bond alternative. Feel free to use the chat box below for questions and to share your thoughts while Craig is live. I'll be keeping a lookout to answer your questions in real time. Also, all attendees are in a drawing for a prize, so stay tuned. We'll be announcing the winner shortly. Thank you for tuning in. And without further ado, Craig, welcome. The mic is yours.
Thanks, Abby. Appreciate it. And thanks, E4, for really giving me an opportunity to spend some time with you guys today. So today's presentation, what I should really point out before I even get started is this is a client-facing presentation. So this is absolutely something you can utilize with clients that really can help you have these conversations around fixed income or bond fund alternatives, if you will. And obviously over the last 8 months with COVID and all, there's certainly been a lot of discussions around their fixed income part of their portfolio, because I think if we look back at 2020, it's going to be remembered as that year of unprecedented uncertainty, because you got COVID, you got interest rates at 5,000-year lows, you get a lot of other variables going on. You got the election. And so there's a lot of things going on all at the same time. And at the same time, we have record numbers in cash right now at $4.6 trillion. It's the highest level since 1992. So if we look at where the consumer behavior is right now, typically with their fixed income, the yields are not what they used to be. And the realization is that is the new reality when it comes to that portion of your portfolio. In fact, if we look at consumer behavior, or I should say investor behavior, Fidelity did a study from February to June of this year during the heat of COVID. And what they found is 1/3 of all investors sold all of their equity positions. And the question is, have they gotten back in the market since? I think a lot of people are a little skeptical about going back in the markets because they don't want to know if they want to take on this kind of risk, because we don't know how far or how long we're going to be in this COVID world. So the reality is, when we know there's a lot of market volatility issues out there, but at the same time, we also know the Fed just recently said they're probably going to keep interest rates low for the next couple of years. So the reality is rates are going to be low for a while, and we can have market volatility for a while. So when we think about, why now and how does it work and why Lincoln? So when we think about why now, the reality is if you were to ask your clients this question, or even if you had a room of prospects right now and said, listen, if you could have 3 wishes or 3 attributes you'd like to see in an investment today, what would they be? And typically, when I've done all these calls this year during COVID, working remotely, is the big 2 are always protect my money, and I want growth and upside potential. And then the third one is I want to pay 0 fees. Very rarely can you check all 3 boxes and be able to get all 3 of those things in one investment. But with a fixed index annuity, you can actually get all 3 of those things. So the reason is why now is because there's a need for it. And the question is, how does it work, and how do I have that conversation with my clients? And of course, why Lincoln? So the biggest thing we found, and a lot of studies have found, that most clients do not understand the inverse relationship between interest rates and bond prices. They don't understand that one thing affects the other. What we found is a lot of clients are unsure exactly how to understand this. And so what we decided to do was to just create a chart for you that you can easily walk a client through and say, listen, just to keep it simple, if I have a $1,000 bond at 1% with a 10-year maturity, if interest rates go down further, you can see that's going to have a positive impact on your bonds. But the reality is, if interest rates start to go up over the next 10 years, let's say, it can have the opposite effect. It's going to have a negative impact on your bonds. If it goes up by 100 basis points, it could do one thing. If it goes up by 200 basis points, it could do even more damage. So the reality is, if we look at bonds, or what's supposed to be typically a safe part of your portfolio, now you've got other risks associated with that. You've got the interest rate risk, you've got the principal risk, and more importantly, you have credit risk. And the reason I say credit risk is because the one thing no one's really talking about is if you look at the nearly $5 trillion that's currently sitting in the U.S. corporate bond index, believe it or not, almost half of that money is currently BBB rated. So what that really means is it's one downgrade away from junk status. So the reality is there's a lot of other risks that are now associated with supposed to be the defensive part of your portfolio or some of your safe money. And the reality is there's a lot of risk there. So when we think about that, we think about what clients are looking for. We recognize that clients are looking for that power of protection. They want to know they have a floor. They want to know if I get in, the worst I can do is zero. And they also want that growth potential. And so the opportunity to get credit and gains along the way if the market appreciates. And the big thing is also the no recovery needed. I think sometimes we forget to tell clients, listen, if you go in the market and you take a 15% loss in the market 12 months from today, you're going to need between 17 to 18% just to get yourself back to even. And the reality is, obviously, if your market goes down even further than that, you got to make up even more lost ground. So the reality is the opportunity to have that power protection, have principal protection, have growth potential, no recovery needed, and more importantly, no fees is really, really important. Now, I actually ran some numbers for you, and believe it or not, we know that we've seen a lot of charts over the years that kind of show you, hey, if you go back 20 years, if you'd missed some of the bigger days in the market, how much would that have actually impacted your return? Looking at 5, 10, 20 of the best trading days. So logically, it makes sense that most clients would understand the fact they need to stay in the market and be committed to the market, not getting in and out. But the reality is, one thing we know is it's a broken record. Every time the market goes down, clients get out of equities, they sit in cash, and they wait to get back in the market sometimes after it's already started to accrue in value. So what I did is I ran the numbers in 2020 through the third quarter of this year. If you look at that right now, if you'd gotten into the market January 1 through Q3 of this year, you'd have a 4.1% return. But believe it or not, if the client had missed the 5 best trading days this year, their average return would actually be, I shouldn't say average return, but their return would be down to negative 27.8%. If they missed the 10 best trading days, they'd be down over 40% for the year. So the reality is, yes, you can have all the upside, but with all that upside potential in the market, there comes that downside risk. And the reality is, if you have a negative return, it's going to take you a long time to get back to even if the market isn't really cooperating with when it comes to growth. So really where Lincoln kind of comes in is where we're really seeing a lot of traction, a lot of value is with our OptiBlend index annuity product. We have 2 indexes in particular I want to talk about. One is our 1-year Fidelity AIM Dividend Participation Index. What that really means in a nutshell is it's a value-based index. It's an index that's only invested in 125 blue chip dividend paying stocks. So companies that have good balance sheets, low volatility scores, companies that tend to pay dividends consistently, and that's exactly what the model is for that index. And you get a par, so you get a percentage of whatever that gain is for the year. You get that credited, and you start fresh the next year. And then secondly, we have our 1-year S&P 500 daily risk control spread. Now, again, I know that's a mouthful. But really what that means is it's a 1-year strategy that's uncapped with a spread, which means you can get 100% of the upside minus the spread. Currently, that spread on our OptiBlend 5 and 10 is a 3% spread, which means the market goes up 10, the client's going to get 7. So the reality is, if I'm looking for something that if we have a V-shaped recovery, something that can potentially give me more upside potential, that would be a great index. And one thing to note, though, is a lot of times with uncapped strategies or volatility control indexes, there's usually a bond component and an equity component. And unfortunately, a lot of times that bond component can be kind of a governor on the performance. because a good chunk of it sits in bonds and only the other percentage of it actually goes in the equity markets. So the way ours works is it's the S&P 500 in cash. So when volatility gets above 5% or greater, we shift some of that money to cash. When that volatility settles down, we shift more money back to the equity side. The other thing that's really important too is dividends are included in the calculation. And if we look over the last 30 years, almost half of the return of the S&P 500 has been dividends. So dividends play a vital role. Now, kind of going back to that Fidelity strategy real quickly again, if we look at this, a starting portfolio, 125 blue chip dividend stocks, dynamic allocation between bonds and cash, and of course the equities, and of course that will make up your Fidelity index. We look at the last 10 years, it's averaged over a 7% return. And again, I talked about dividends and why dividends play such a vital role when it comes to your returns. If I look at scenario one and I look at the 1930s, the 10-year treasury was hovering about 4%, believe it or not. And for 34 straight years, including the 1930s, the 10-year treasury was at a very low point. But if we look at the 1930s on the equity side, it was actually negative for the decade of the 1930s, but dividends averaged a 5.4% average return. If I look at something more recent, like the lost decade, like 2000, 2010, again, the market's negative for that 10 years, even though 6 years were up, 4 years were down, because you had to make up that lost ground. But dividends average almost a 2% return. So the reality is a fixed index annuity, especially with good index strategies that can potentially give you more upside potential, can be a great fit right now to go back to clients right now that are either sitting in cash, they're currently in CDs, or are looking to kind of de-risk the fixed income part of their portfolio. So with that, I'm going to throw it back to E4.
Thanks, Craig. I've opened up the line to the audience if you have any questions. And if you were inspired by the concept or products that Craig shared today, feel free to reach out to your dedicated partner at E4 Insurance Services and we'll get you on your way. Craig, now comes the time where you get to choose the lucky winner for the prize. Will you choose a number between 1 and 17, please?
I'm going to go with 8. Number 8.
Ooh, who's the winner? Who's the winner? Oh, Corey Myers, congratulations. Be on the lookout for an email coming your way from E4 Insurance Services with a special prize of a Starbucks gift card. Be sure to tune in next Wednesday for The Brew. We'll have Patrick Robertson of AIG discussing VUL solutions as well as chronic illness protections. Thanks, friends. Happy fall and make it a great day.